Thanks for visiting this video. Today I'll be discussing the U.S. Federal 1040 long form for 2014. My name is Sergio Estavillo. I am the founder and principal of Sigma Financial Solutions, which is a company designed to assist health professionals in their tax, accounting, and student debt management issues with respect to student debt, particularly if you're in income-based repayment or pay-as-you-earn, one of the income-driven repayment options, how to best manage those types of repayment options, as well as, again, tax accounting issues, if you need tax preparation, things of that nature. I'd certainly be more than happy to discuss that with you. Here's some contact information. Feel free to email me or give me a call at that number. I also would suggest that you visit my Facebook page, which discusses several different issues, from retirement, saving or investing for retirement. I do, suggest that you look at this article. It's something that would encourage you to invest as soon as possible, because right now you have time on your side in order to save and benefit from compounding interest with respect to retirement and other long-term investment objectives. This just gives you a table of the returns for the S&P 500 over the course of about 60 or 70 years, well, actually about 80 years, based on different asset classes. Just a quick blurb of pay-as-you-earn or IBR. One of the concerns with pay-as-you-earn and or IBR is, even though any balance remaining after 20 or 25 years is forgiven, right now it's classified as a taxable event. So how to prepare for that tax event, and some just various articles. But again, feel free to contact me if you do have questions or concerns. And I'm also a Intuit Pro Advisor certified advisor. So if you're using QuickBooks, online, things of that nature, I'm more than happy to discuss any questions you might have. So this is just kind of a conceptual presentation of the federal 1040 long form, kind of a formulaic expression of how they arrive at the federal income tax. And let me go over some of this information quickly. So gross income. What are all your types of income that are being captured on the federal 1040? So that would include wages if you're a W-2 employee. It would be your net profit from your business if you're an independent contractor. If you formed an S corp for whatever reason, it would be the wages that you would pay yourself as an employee of your own S corporation, as well as any net profits. Those would be considered some of the types of income that would be included in your gross income. So from gross income, you subtract out your adjustments. The adjustments I'll discuss in just a second. Once you subtract out your adjustments from gross income, you arrive at your adjusted gross income, or AGI. And AGI is critical if you're in IBR or pay-as-you-earn, because that's what they use to determine your monthly payments under those repayment options, IBR or pay-as-you-earn. So it's critical to take advantage of your adjustments to lower your AGI, which then in turn lowers your payments under IBR or pay-as-you-earn. From your adjusted gross income, we try to determine your taxable income. And unfortunately, a lot of individuals think your AGI is your taxable income. It is not. Your AGI is higher than your taxable income, just to make that distinction known. Your AGI is not your taxable income. So from your adjusted gross income, you subtract out the larger of your standard deduction or itemized deductions, whichever is greater. Unless you own a home or live in a high state tax, live in a state where they have high state income tax, which California is, you'll probably need to you'll probably need to take a standard deduction. If you're able to itemize and your itemized deductions exceed your standard deduction, then you would want to pursue itemized deductions. But as for a single individual, your standard deduction is $6,200. So if you can only use the standard deduction, you could subtract out as an individual $6,200 from your adjusted gross income. In addition to that, you have exemptions, which are essentially kind of dependents. You would include yourself and any dependents that you provide financial support to the level that's required by the federal government. So if you're a single individual, there would be one exemption. So one exemption for 2014 would allow you to deduct another $39.50 from your adjusted gross income. So the combination of your standard deduction, I'm going to assume a standard deduction for a single individual of $6,200 plus one exemption of $39.50 means that you would be able to reduce your adjusted gross income by a total of $10,150 to arrive at your taxable income. And once you determine your taxable income, then you look at the tax rates established by the federal government. So you would determine your marginal tax rate. You would multiply that marginal tax rate times your taxable income to arrive at your federal income tax. So again, just kind of a quick formula expression of your 1040 to give you kind of a general sense of how they arrive at your federal income tax. And one of the critical things about this process when you're analyzing it for IBR or pay-as-you-earn is to make certain that you're aware of what type of income is included in determining your gross income. So say you're an employee of a corporate office, you work at PDS, or maybe you work at Smile Care, or maybe you work at Western and you're paid as a W-2 employee. So your wages would be included in your gross income. Or say that you're an independent, you're paid as a 1099 independent contractor. Then the key to this is determining what your business net profit, and you do that by completing Schedule C, and I'll get into some of the forms in just a minute. But that net profit then is considered a part of your gross income. Or say you formed an S corporation, for whatever reason you formed that S corporation, then you might have two types of income that are generated by the S corporation. So you're an employee of your own S corporation, and as a result, you pay yourself a W-2 wage. Then you also need to determine the net profit that's being generated by the S corporation. So the combination of those two would be considered in income. Some other types of income that would be included in gross income: capital gains. You're buying and selling stock, and as a result, you may have a net capital gain that would be included in income. Maybe you own some rental property. That income that's generated from the rental property will be included in the gross income. Say you're fortunate, you head out to Vegas, you win a little bit. I believe the casinos are required to report any winnings in excess of $600 through a 1099 miscellaneous income, so that could potentially be reported as gross income. So those are the types of income that would be included in your gross income, which is something different than adjusted gross income. One of the things you want to be aware of and try to take advantage of is the adjustments to income. Some things that lower your gross income to arrive at your AGI. And again, AGI is key if you're in IBR or pay-as-you-earn in terms of student loan repayment option. So some adjustments that you would take into consideration are deductible individual retirement account or an IRA. So say you're a W-2 employee or a 1099 IC, but as a W-2 employee, um, your corporation is not providing you with a retirement account or necessarily any benefits whatsoever. So potentially you can open up an individual retirement account or IRA, which would lower your gross income. Um, or another consideration another consideration is a health savings account or HSA. Say you have no benefits either as a W-2 employee or an independent contractor, you have to buy your own health insurance. And as such, you buy a high deductible health insurance program, you can set aside some money for out of pocket expenses by virtue of a HSA, and that investment can be used to reduce your used to reduce your gross income in the form of an adjustment. So if you're self-employed, another consideration would be what's called a simplified employee pension program, or SEP, or simple retirement account. You know, these types of accounts could be larger than the deductible IRA. So if you have funds in excess of $5,000, maybe that's a consideration, is opening up or establishing a SEP or simple IRA account to increase your adjustments to lower your AGI. And again, here the goal is to lower your AGI so that your IBR payments or your pay-as-you-earn payments are lower. But let me go ahead and introduce some of the tax forms, and I'll primarily discuss under 3 employment tax scenarios. So first being a W-2 employee, second would be a 1099 independent contractor, and a subset to that may be that you're 1 and 2. So you're a 1099 independent contractor, say for 3 days a week, and then you're a W-2 employee an additional 2 days a week. So I'll discuss the combination of those two, and finally the S corporation. Much more complex, so I'll go over that briefly. The S corporation is a separate legal entity than the individual, so it requires you to complete not only a 1040 long form on the individual level, but it also requires you to complete another federal form called the 1120S for a corporation. So it's much more complex, and I'll just go over that briefly. So let me go ahead and bring up some of these forms. And the first form that I'll bring up is the 1040 long form, which apparently I don't have open right now, so let me go ahead and search for that. Let me do a quick search, and let's see if we can't bring up the form. Just 1 second. So I'll be introducing the 1040 long form. It is in draft version right now. They should complete the final version by probably mid-January, but this is the form itself, the draft version. So for the 1040 U.S. individual income tax return for 2014. So the top portion of this form just completes some demographic information, so pretty straightforward. Here is probably your first critical decision, if you're married. If you're single, it's pretty straightforward, so your filing status would be single. But if you're married, you can choose to file jointly or separately. And this is where it's important that you have a tax professional who's familiar with this option with respect to IBR or pay-as-you-earn. So it may be better for you to pursue married filing separately to exclude your spouse's income so that your IBR or pay-as-you-earn payment is lower. Otherwise, if you're married filing jointly, your spouse's income will be used to determine your pay-as-you-earn or IBR payment, and as such, your payments may be higher. So a shameless plug here. I'm very familiar with this process, so I would suggest that or I would ask that you consider me for this purpose and for other reasons as well. But, this is one of the first critical decisions is whether you should, if you are married, is whether to pursue married filing jointly or married filing separately. Now, most married couples do file jointly because it allows them to be considered for additional tax credits and or tax deductions, which ultimately lowers their tax liability. But the analysis that needs to be made is maybe by married filing separately, excluding your spouse's income would result in a lower monthly payment in IBR or pay-as-you-earn, which would result in greater savings than married filing jointly. So that's something that you would want to consider, is by married filing separately, lowering my student loan payments, is that uh, savings greater than the increase in your tax liability? Again, critical when you're making that decision. So, as I mentioned, if you're single, it's pretty straightforward. I'm going to go under that assumption that you're single. Exemptions. How many dependents are there in your household? You would include yourself. Um, so if you're single, it's just one. That would mean that you could lower your taxable income by $3,950. But say you're married and you have, two kids. Potentially, you would have then a total of 4 exemptions that you could claim. But again, depending upon how you decide to file, could influence whether you can claim your spouse. So it could be that you're married, you decide to file separately, you wouldn't be able to claim your spouse, but that doesn't mean that you couldn't claim your kids. So whatever is of greatest financial advantage to you, that would have to be determined. So it's something that makes this process a little bit more complex. But I'm going to, again, assume that you're single. You can only choose single, and you can only claim one exemption, and that would be yourself. So under the assumption first that you're a W-2 wage earner, so you're employed again by, say, a corporate office, PDS, SmileCare, something of that nature, and you generate a wage, and let's just say your wages are $90,000. So I'll include that amount here. Line item number 8, taxable interest. Say you have a savings account that's generating interest, that could be included as total income or gross income. Tax exempt interest. Maybe you have um, an investment in a government bond or a municipal bond, something of that nature, that is exempt from tax interest. So it's probably not the case. You probably don't have these items here. If you received a state refund from a prior year, from 2013, that would be considered income for 2014 from a federal perspective. You're divorced and you're receiving alimony from your former spouse, that's considered income. Business income, this would be applicable if you're a 1099, and I'll get into that in just a second. You have to complete Schedule C in order to arrive at your net business income, which then would be reported on line item number 12. But I'll get into that quickly, briefly, in just a second. Capital gains, you're buying and selling stock. As a result, you realize some gain. That will be reported on line item number 13. I'm going to skip these next ones because they probably don't apply. Let's say that you have some rental property, you're generating some income. The net income and net profit from that state and is then reported on line item number 17. Also make note, S corporation net profits are reported on here as well, and I'll get into that situation in a few minutes as well. I'm going to assume that you don't have a farm and you're not generating any income from a farm. Line item number 19, you receive some unemployment benefits, and those are considered taxable income, so you would report that on that line item. 20 doesn't probably apply. You're not old enough to receive, I'm assuming you're not old enough to receive income from Social Security benefits. Line item number 21, some of the type of income that might be reported here would be, again, you're lucky, you get some winnings while in Vegas, and they report that you won a net of $1,500. So that's considered taxable income as well. So in a W-2 situation, then under these assumptions, that you would have total income of $91,500. And I'll get into a 1099 in just a second, but let's just move forward from here. So this is your total income, and from your total income, there's some adjustments that can be made to lower your total income to arrive at your AGI. So as I mentioned earlier, say maybe your corporation doesn't provide any benefits, you pay out of pocket for health insurance, and it's a high deductible health insurance program, and you want to set aside some money for your out-of-pocket expenses, and you can do so in the form of a health savings account or HSA vehicle, and this helps you to lower your adjusted gross income, which then in turn benefits you in your IBR or pay-as-you-earn repayment option. So say, I forget the maximum allowable per year, but let's just say that you set aside $2,000 for that purpose. So that could lower your AGI by that amount. And I'll go over just a couple items. Say the IRA, the individual retirement account deduction. Again, your employer doesn't provide you with any of those benefits. You decide to establish a retirement account early to benefit from the compound interest over the over a 30-year or 35-year retirement window or investment window, but you set aside the maximum amount, which is $5,000. So potentially these two reduce your total income to arrive at your adjusted gross income. Student loan interest deduction. So you're eligible up to a $2,500 interest deduction so long as you don't exceed certain income limits. And I believe for a single individual, your total income cannot exceed $75,000. Once it exceeds $75,000, you no longer qualify for that student loan interest deduction. For a single individual, I believe it begins to get phased out at once your income equals $60,000, and you lose it completely once your income exceeds $75,000. So under these assumptions, total income is $91,500, so you don't qualify for any of that student loan interest deduction, which is up to $2,500. So in this case, you exceed the maximum income, therefore nothing is available to you. So your adjustments to income total $7,000. That means your AGI then is $84,500. This $84,500 is used for IBR pay-as-you-earn. So if you could take advantage of these adjustments to income and realize a lower AGI, that means that your payments in IBR or pay-as-you-earn are going to be lower as well. So certainly something to consider. Discuss with your tax professional to make certain that you're taking an advantage of it as best as possible. So I'll go on to page 2, so you carry forward that AGI at the top of page 2, so $84,500. These probably don't apply to you. And here we get to itemized or standard deductions. So you want to take the greater of either the itemized deductions or standard deductions. In most cases, you would only qualify for itemized deductions if you have a mortgage and the interest is deductible from that mortgage. So you own a home, that home has a loan against it, and the interest that you pay is potentially deductible. Then once you have itemized deductions that exceed $6,200 for a single individual, then it's probably best for you to pursue itemized deductions. Another situation where you might be able to itemize your deductions, if you live in a high state income tax, a state with a high income tax, which California is. So if you're a high wage earner and you live in the state of California, it may be that your state income tax might be high enough to allow you to itemize your deductions. As a single individual, I would expect your income to be $150,000 or greater in order for you to itemize your deductions, just to give you kind of a benchmark there. Otherwise, you would be eligible for a standard deduction, and reference the left margin here. So if you're single or married filing separately, your standard deduction would be $6,200. So I'm going to make that assumption, that you only qualify for a standard deduction of $6,200. Then from here, let's just jump to line item number 42. Here is where you're able to claim your exemptions or dependents. And for each dependent or exemption, you're able to lower your adjusted gross income by $3,950. So I'm assuming in this example only a single individual, so you can only claim one exemption of $9,500, or to me, $3,950. But say you're a family of 4, then you multiply 4 times, $3,950. So you can exclude up to almost $16,000 from your AGI to arrive at your taxable income. So here, the next item, number 43, is establishing or determining your taxable income. So your taxable income is your adjusted gross income less your standard or itemized deductions less your exemptions. So in this case, in this example, it would be $84,500 minus $6,200 minus $39.50. So I have a taxable income of $34,350. And from here, there are some credits, but they're highly dependent upon income. Credits lower your taxable, your tax liability, but again, it's highly dependent upon. It's highly sensitive to income. So as your income gets higher, you'll probably be phased out of those tax credits. So I'm just going to assume for now that your tax liability or your taxable income is $74,350. You reference your tax tables to determine your marginal tax rate, and you multiply that by your taxable income to arrive at your federal tax liability, just to give you a sense of a W-2 employee. But let's take the example of an independent contractor. So what becomes critical here is this business income. So as an independent contractor, you're expected to complete Schedule C. And let me reference Schedule C now. So Schedule C is for a independent contractor, also known as a sole proprietorship in kind of tax language. The Schedule C top portion is fairly straightforward, just some demographic information. Let me assume typically with sole proprietorship, your accounting method is cash as opposed to accrual, excuse me. So your cash basis entity. Um, Part one of this form is trying to capture income information. So it's your gross receipts or sales. Your gross receipts are really the cumulative total of all your 1099s. So you'll receive your 1099 miscellaneous income forms by the end of January, and you total those up. So let's assume that I've totaled all of these up, and you have $100,000 in gross receipts. Um, Line item 2 doesn't apply because you're a service organization. So normally there's no returns or allowances. If you're producing a tangible product, there may be some returns and allowances, but in this case that probably doesn't apply. So line item number 3 is $100,000. Cost of goods sold, again, this doesn't apply because you're not producing a tangible product. You're providing a service, so that's zero. So your gross profits are $100,000. You're probably not receiving any federal, state, gasoline, or fuel tax credit. So your gross income is $100,000. In Part Part 2 of Schedule C are the business related expenses that you can deduct from your gross income to arrive at your net profit. So I just made um, some figures up here. Advertising, you've printed up some business cards, you've developed a website, you have to pay a monthly fee. So let's assume $500 here. You use your car or truck for business related items, and I just made an assumption of $2,000 here. Here you can include, say, malpractice insurance of $2,000, and you get a sense of the different types of expenses that can be included here to lower your net profit. You have some deductible meals and entertainment expenses here. I put $500. Then on line item number 27, other expenses totaling $5,000. This might include, say, CE courses, renewal of your dental license, of your DE license, association dues, things of that nature. So total expenses then are $10,000. You subtract that from your gross income of $100,000 to arrive at your net profit as an independent contractor. So this $90,000 passes through Schedule C onto line item number 12 on the federal long form. So here it would be $90,000. And again, let's just assume that you have some additional income on line item 21 because you were lucky in Vegas. So again, total income is $91,500. You try to take advantage of adjustments to gross income to lower your AGI. So again, this will apply. You probably have to buy your own health insurance as an independent contractor. Maybe you buy a high deductible health insurance program that allows you to establish a health savings account. As part of the independent contractor, you're allowed to deduct your health insurance premiums here. So maybe your premiums are $1,500 over the course of the year. And you're also allowed to establish, as an independent contractor, what's called a simplified employee pension, a SEP, or a simple program. There's some other qualified retirement program. And these programs are more generous than the IRA deductions, but usually you can't qualify for both. It's one or the other. So I believe for the SEP in 2014, the most you can contribute to a retirement program under SEP is $53,000. So the allowance is much higher, $53,000, but are you in a position to take advantage of that maximum amount? Say you're not, but say you are able to set aside, say, $7,500 as opposed to $5,000 in the IRA. Something to consider. So in this case, you would have total deductible or adjustments to income of $10,000. So your adjusted gross income would be then $81,500. And the process continues the same way. Your adjusted gross income on page 2 would be $81,500. You have the standard or itemized deductions. Then you have the exemptions that you would take into consideration. Let's not change those two items, but let's say $81,500 minus the standard deduction of $6,200 less the one exemption as a single individual of $3,950. That means your total income or taxable income would be then $71,350. Then you reference the tax tables again to see what your marginal tax rate is. Use that marginal tax rate to determine what your federal tax liability is. So that gives you kind of a sense of a W-2 wage earner as well as an IC. It could be that you have a combination of both a W-2 as well as an IC. Say you're working 3 days in a corporate office and 2 days in a private practice where they pay you as an IC. So maybe it is that you have, say, $50,000 of W-2 wages, and once you complete your your Schedule C, maybe it is that you have $40,000 in an IC employment situation. So you could be a combination of those two as well. The final employment status is maybe that you're an S corporation. For whatever reason, you formed an S corporation. It may not be to your advantage to form an S corporation because you're just paid as an independent contractor. It probably is to your best benefit to form an S corporation when you own your own practice. In that case, you're probably more concerned with liability exposure, so you establish an S corporation to protect your personal assets and have limited liability as a result of an S corporation. But forming an S corporation as an IC may not be in your best financial interest. You would probably want to do so once you own your own corporation, but as an IC, you may want to form an S corporation when you own your own practice, but as an IC, it may not be in your best financial interest to do so. But let's just assume that you have an S corporation, and within an S corporation, you pay yourself a wage. So you establish that wage, which is reasonable, and just for discussion purposes, let's say it's $50,000. Then you need to arrive at the net profit of your S corporation. So the S corporation is a separate legal entity from you, the individual owner of that S corporation. So the S corporation is required to complete an additional federal tax return. So, and it gets very complicated completing the S corporation. But let me introduce that form to you. I believe I have it up. Yes, I do. Much more lengthy, but I'm just going to show the first page of the U.S. income tax return for an S corporation. Again, kind of some basic information they capture up front. Let's assume that your gross receipts, that you form this S corporation uh, as an independent contractor, that you do not have um, your own practice, but you're just being paid as an independent contractor and you form an S corporation for whatever reason. So let's assume that your gross receipts um, come out to $100,000. Um, line item 1C is $100,000, and you can get a sense of what's happening here. So total income from your S corporation is $100,000, but you pay yourself a wage, and that wage is reported here, $50,000. Then you could deduct business-related expenses, and I'm just assuming that those amount to $10,000. And as a result, you have ordinary business income of $40,000, and that income passes through uh, the corporation from line item 21 to the individual income tax return on line item number 7 of your personal tax return. Excuse me, line item number 17 of your personal tax returns. So here it would be reported the S corporation net profit of, say, $40,000. And I'm not going to change this. Let's assume that you continue your lucky streak in Vegas and you have another $1,500 of reportable income. In this situation, you may not be able to take advantage of some of the adjustments to income if you're a S corporation. You may be able to realize these benefits in the S corporation itself. So maybe you could lower your business income by paying some of these benefits through your S corporation. But I'm just going to assume nothing here, and as a result, you have no adjustments to income, so your adjusted gross income is then the total of your incomes up there. So it's $91,500. And then this just carries forward, and then you continue with the itemized or standard deductions, the exemptions, and then in this case your taxable income would be $81,500. I don't want to mislead you to believe that the S corporation isn't of benefit to you. As I mentioned, within the S corporation, you can create some benefits that are deductible for business-related expenses, which would lower your net profit. But it's a very complex situation. I just wanted to give you kind of an overview of the three various the more common employment situations to give you a better sense of how that is addressed from a federal perspective. If you have questions or concerns, please feel free to reach out to me, contact me. This is a good time to start to develop tax strategies for 2015, complete your 2014 tax strategies. There's still things that you can do in order to lower your tax liability, and to plan for IBR as well as pay as you earn. One of the biggest concerns with those two repayment options is that after 25 or 20 years in those repayment options, any balance is forgiven, but it is considered taxable income, so you need to begin to invest and prepare for that now. So reach out to me if you have questions. I appreciate you spending the time, and I look forward to providing any assistance that I can. Again,